It's Friday, 16th of May, and this is your Capital Economics Weekly Briefing. I'm David Wilder. Coming up, what next for financial markets after that post-Liberation Day relief rally? And is Germany's turnaround enough to secure the future of Europe? But first, Neil Shearing, Group Chief Economist, is with me once again to sift through the detritus of another week in global macro and look ahead to the coming 5 trading days. Hi, Neil.
Hi, David. We can aim for a slightly higher bar than detritus, nonetheless.
Well, nonetheless, I mean, what a difference a week makes, right?
Indeed, what a difference a week makes. Trade war over, equity markets up, calm across bond markets. It's almost like the past 2 months didn't happen.
It was all a dream. You say trade war over. Is that the case? There is certainly, if you look at what's happening in markets, I'm going to be speaking to John Higgins, our Chief Markets Economist, in a bit. They certainly are trading as though it's all over. I mean, is that how things are looking for all intents and purposes?
Well, it's how the markets are trading. I say it's slightly tongue-in-cheek because I don't think it's all over, actually. I think clearly there's a truce. There's a sense that, for want of a better word, the adults are back in charge of policy in the US. Scott Bessent and Jameson Greer, the US Trade Representative, clearly in the ascendancy. Notable that they were the ones leading the talks with China in Switzerland last weekend. But I think if you cast your eye forward, there's still some pretty substantial obstacles to overcome, both to actually agreeing a deal with China, which I think is still the most important deal to be done, but also with other countries. And of course, I think there's a really critical risk here that at the moment, Scott Bessent, as I say, has the microphone. He seems to be in the ascendancy. He has Trump's ear. But there's plenty within the administration that have a far more hawkish view on trade. Peter Navarro, for example, seems to have been relegated to the back seat for the time being, but it's not impossible to imagine that at some point he might gain the ear of the president once again. And of course, the president himself, notoriously, how should we say, volatile and capricious when it comes to some of these issues. So yes, I think we've stepped back from the brink, we've stepped back from the precipice, is how I would characterize it. But I don't think this is necessarily a kind of lasting truce. I think there's plenty more obstacles to overcome.
Yeah, volatile and capricious. I've heard much worse over the past few weeks. But in terms of what's to come, talk about where we are now, where we're going to be going over the next few weeks. What should we be watching for?
Yes, there's plenty of flashpoints over the coming weeks and months. I think the most obvious comes on the 8th of July when that original 90-day pause on US reciprocal tariffs on most countries expires. So there's a window there for countries to try and do deals. I don't think for 1 minute that all countries are going to do deals by the 8th of July. And I think the most likely outcome is that deadline gets rolled over. Maybe we get another 90-day window to do a deal. But there's a good chance that it goes down to the wire before any extension of that this window is announced. And if that's the case, plenty of scope for volatility in markets. And of course, if you keep extending the window, then you lose all credibility if you're the US. So you may be able to do it once, maybe able to do it twice, but you're not going to keep being able to do that in perpetuity. Then, of course, you've got the 12th of August deadline, which is the 90-day window to do a deal with China. At the moment, both sides seem to be talking up the prospects of a deal. But of course, there's some pretty thorny issues to debate here too. It's not just tariffs, it's things like industrial policy, exchange rate policy, intellectual property. It depends quite how wide the US administration wants those talks to become. So potential for those talks to unravel, because I think fundamentally that the fundamental issues at stake here are not going to be fully addressed. And then, of course, when it comes to the deals themselves, there's some pretty big ones to still where we're waiting for noises or signs, evidence of progress. The most obvious being with Canada and Mexico. The US, Canada and Mexico now, all three seem to be suggesting that some renegotiation of USMCA, which is not due until next year, could be brought forward, which I think would be a sensible idea, but it's going to be quite difficult to renegotiate. And it, again, depends slightly on what the US side wants. Do they just want simply a kind of bit of window dressing and a few tweaks, or are they striving towards more radical objectives, more radical revisions, for example, steps to incentivize the relocation of auto production to the US, or maybe to tighten rules of origin to prevent transshipment of Chinese goods, for example, through Mexico to the US. So that's a key area to watch. So plenty of potential flashpoints over the coming weeks and months.
And I wanted to ask about China, actually, because Trump talking about a total reset in US-China relations at Geneva. But then you've got people who've been following US-China bilaterals down the year, and they've all been noting that the rhetoric that came out of those meetings all sounded quite familiar. The communications talking about mechanisms for further negotiation and the healing of relations. Are they just a bunch of cynics, or should we be managing our expectations lower in terms of what we can get here?
No, I think there's something to this, right? I think if you look back over the course of George W. Bush's administration and the Obama administration, they each had bilateral dialogues with China around trade and around economic issues. And they would all come out and say, there's lots of difficult issues to discuss, but the great thing about strong relationships is that you're able to bring up these difficult issues in a constructive setting, and we'll work towards solutions that are mutually agreeable. And people like Peter Navarro have been scathing about those processes, essentially suggesting that it allows China to string out discussions without ever conceding ground. And as a result, the US ends up in a situation where it's running these large trade deficits, China's running these large trade surpluses, the US industrial sector's being hollowed out. Now, this is not all about China. There's other kind of non-trade related issues to do with deindustrialization in the US too. But the point being that other administrations have pursued exactly this kind of dialogue-based approach with China, going all the way back to George W. Bush, and they've got nowhere. And so in a sense, characters like Peter Navarro are right to cast doubt over whether this will lead to any kind of meaningful breakthrough too. I'm rather skeptical that it will.
And then the bigger picture, if you look at why Trump talked about imposing these tariffs in the first place, it all came down to the fact that the US is running these massive trade deficits. And it does seem to me that for all of the sort of the bonkers ideas that have come out of the White House over the past few months and on the campaign trail, indeed, there has been this legitimate point, hasn't there, that the Trump lot have been getting to about global imbalances, about the fact that the US doesn't save enough and that China saves too much. And for all of what we've seen over the past few weeks, these imbalances are not going to get addressed, are they? So what are the risks here?
Well, I think you're right. As we've talked about before too, that there's something to the idea that global imbalances are a problem, that the US trade deficit is a problem. It's just not for the reason that Trump thinks it's a problem, right? It's not because it somehow means the US is losing in the world because it's running this deficit. Rather, the issue is that for every dollar of deficit that the US runs, it must be accumulating an equivalent dollar amount of external liabilities. And if you do that over a long period of time, you build up this large stock of external liabilities that creates vulnerabilities in your balance of payments. And if you have the world's reserve currency, the world's dominant global currency, then that allows you to accumulate large external liabilities to a greater extent than other countries, but you can't do it ad infinitum. So that's the real issue. It's the fact that the counterpart to the world's second largest economy, China, running at this enormous trade surplus and current account surplus, is that the world's largest economy, the US, must run a large deficit. And as a result of running this deficit, it's accumulating large amounts of external liabilities. So that's the key issue. Now, this is partly made in China, and it's to do with China's excessively high savings rate, as you suggest. But it's also about the low savings rate, correspondingly low savings rate in the US. And if you look at what's happening away from trade in the US, then you get this sense of inconsistency within the Trump administration's approach. So look at the tax bills that are currently making their way through Congress. It's uncertain as to exactly where they're going to land. There's going to be a bit of horse trading back and forth as they make their way through both houses of Congress. But it's not going to fundamentally narrow the US budget deficit. And if you don't fundamentally narrow the US budget deficit, then you don't fundamentally narrow the US trade deficit, I'm afraid. So the Trump administration may talk a good game in terms of wanting to do a deal with China to narrow the US trade deficit. It might think that it somehow wins as a result of that. It doesn't. But if it's running these large budget deficits, 6-7% of GDP at the same time too, then there's no way on earth that it's going to narrow its current account deficit or trade deficit. So some inconsistencies, to put it mildly, within the administration's approach.
And plus ça change. I just want to come back to the present day, though, because regardless of where we go to in the coming weeks, it does seem likely, doesn't it, that the US tariff rates are going to stay at multi-decade highs. I ask you every week on the podcast, I'm sure you're probably getting bored of the question, but Are we seeing anything coming into the data to suggest that tariff levels are biting?
Not yet. So if you look at the data that we've had released over the past week or so in the US, pretty solid retail sales numbers for April. Admittedly, control group sales were down 0.2% month on month in April, but that followed a really large gain in March. And if we look at the data coming in so far, we're forecasting a pretty healthy gain of just under 3% Q-on-Q annualized in private consumption in the second quarter of this year. So no sign yet that consumers are feeling the pinch. And the industrial production data from the US in April, while flat in month-on-month terms, weren't disastrous either. So no sign in the actual activity data that tariffs are having an impact on the US economy. However, we have had an announcement by Walmart in the past 24 hours that it will start to put up prices in response to tariffs. And we've had some pretty soft CPI and PCE data, and we think likely PCE data in April, but maybe in May, then there's some signs that tariffs are going to feed through into inflation. So keep an eye out there. And also, we've developed our own global trade stress monitor to track the different stages of the trade cycle in order to identify potential areas of stress and strain caused by tariffs. And while at the end of the trade cycle, so shipments to the US, shipments through the US, and production and consumption in the US, there's no signs of strain, as I just suggested. If you look earlier on in the cycle, so if you look at factory orders being placed in key exporters to the US, there is some evidence that's weakening potentially in response to tariffs. So not enormous strains, nothing that looks existential or disastrous at this stage, but some signs of modest strains emerging at the very start of the very early stages of the global trade cycle. So again, something to keep an eye on. So nothing in the data so far, potentially something coming in the May CPI data, if you believe Walmart's announcements. And I think we should probably take that at face value. And in the early stages of the global trade cycle, some evidence of disruption from tariffs, but nothing really substantial at this stage.
But that stress monitor you mentioned, you would expect, if you're seeing it in the earliest, it's 7 stages of the trade cycle, isn't it? So if you're seeing it in the earliest ones, you would expect as the weeks progress that start feeding through.
Yes, you would, but keep in mind there's scope to absorb quite a lot of stress at each of those stages. For example, if importers have accumulated large amounts of inventory, and we know that shipments into West Coast ports, for example, in the first 4 months of this year were running 10-15% above what they were in the first 4 months of last year, then there's inventory that's been accumulated, and that acts as a kind of buffer to some of this stress through the different stages. So just because we've seen some early signs of stress early on in the trade cycle, doesn't mean that will necessarily ripple through on a kind of week by week, month by month basis.
Okay, that point you make about Walmart, that was interesting, wasn't it? Warning about how they're going to have to raise prices. And actually, important to say, not the only company this earnings season to make that point, but probably the most notable, given the uncertainty that you're talking about in terms of how this all feeds through the trade cycle. What do you think is going on at the Fed? How do you think officials there are looking at all of this? You'd think they would have a bit more clarity this week along with the rest of us. On the other hand, they have spoken before about the uncertain impact of tariffs in terms of, does it lead to slower growth? Does it lead to higher inflation? So how do you think that one plays out?
It's a good question. I suspect on the one hand, they're breathing a sigh of relief. As I said earlier, we've stepped back from the brink when it comes to global trade war. That's positive. On the other hand, as we've also discussed, there's plenty of ways that could unravel. And if you look at the incoming data, there's not much sign that the US economy is really struggling. Inflation's pretty benign at this stage. So my sense is that they're in wait and see mode, and why not, right? The economy's seems to be doing okay, relatively resilient so far. The inflation data has broadly behaved at this stage, likely to tick up in the next month or so, mild stagflationary hit. I think piece all that together, and given the uncertainty, probably just stay the course, which interestingly, we've had that view for a while that rates won't be cut in the US this year because of the mild stagflationary hit from tariffs. If you look at the repricing at the front end of the yield curve, the US yield curve, over the past week or so, the market's coming around pretty quickly to that view too.
That was Neil Shearing on the Fed and the global economy in a better place, but with much that could still go wrong. And since I spoke to Neil, we've seen headlines saying the US is basically going to hand down tariff rates to some of its trading partners in the coming weeks. So a reminder that this is a fluid situation and we are continuing to track developments. The global trade stress monitor that he mentioned, I will add that to the podcast notes. As we discussed, it shows you how higher tariffs are feeding through the trade cycle. So well worth bookmarking that, as it's already showing that conditions are changing further up the chain. In the coming week, I wanted to note we're holding some drop-ins. These are our short-form online briefings. On Monday, it's a response to key weekend elections in Romania and Poland. On Tuesday, we're discussing how the pandemic will continue to shape CRE returns across the US and Europe. On Wednesday, it's a session about South Africa. The ANC is trying to table a budget for a third time, believe it or not, and hold the governing coalition together. And finally, on Thursday, we've got sessions all about the future of Europe. Details of all of these are available on our events page, which I will link to in the show notes. And it's worth mentioning that to get invites to all of these sessions and more, do check out CE Essential and CE Advance, our all-access packages. Anyway, back to the future of Europe. This is a major project with analysis and data that we've launched this past week in London. It's designed to explore the drivers of a stunning turnaround in sentiment in recent months. This past week's releases include reports on everything from defense spending to the potential of the euro to challenge the dollar's reserve currency status to the UK's relationship with Europe. In the coming week, there's going to be analysis on EU expansion and Europe's potential as a third superpower, among other topics. At the heart of this question about Europe's future is Germany's ability to turn its economy around. Franziska Palmas, who is a senior economist on our Europe team, is authoring a paper on that very question. That's due in the coming days, and I spoke to her earlier about the work, and I started by asking what's really changed in terms of Germany's economic outlook.
Yeah, I think we've seen a big shift in the narrative about Germany after the national fiscal rule there was loosened, paving the way to a big increase in defense and infrastructure spending in the future. I think initially there was a very big surge in optimism about the prospects of the German economy after that announcement. Maybe that has moderated a bit now, partly because of then the Trump tariffs coming into the fold. But I think in general, there's still some optimism that the new government will get Germany out of 6 years almost now of stagnation.
That stagnation, I mean, you talk about the fiscal rule, really less a rule, more a straitjacket on the German economy. So put some numbers on it in terms of how much of a shift that we've seen. Because certainly within the culture of German political economy, it has been quite notable, hasn't it? This move away from fiscal tightness.
Yes, it's definitely a big change, especially to the type of fiscal policy that we saw during the 2010s when Germany was running with big fiscal surpluses. In terms of what we're talking about, we're thinking about an increase in spending on defense and infrastructure combined that could amount to around 0.8% of GDP per year in both 2026 and 2027. That is obviously very significant. And we think that it will give a significant boost to the German economy and cause it to grow by perhaps around 1% in 2026 and 2027, which compares, as I said, with 6 years of broad stagnation since the pandemic. That said, 1% is still way below the 2% growth that we saw in the 2010s.
Obvious question is why, if 0.8% of GDP, as you say, is in terms of fiscal firepower is pretty significant, why isn't it going to translate into a higher pace of growth? As you say, 1%, yeah, better than zero, but no great shakes.
Yeah, I think the main reason is that the fiscal stimulus, yes, it will cause in some sense, a temporary increase in demand, but it will not address the what are some big structural factors that are dragging on German growth and will continue to do so in the rest of this decade. To mention two that are really key, one is a very poor demographic outlook. The working age population is set to shrink by between 0.4 and 0.8% per year, depending on the year in the rest of this decade. That will be a big drag on growth. Like, we're expecting employment to start contracting at some point later in this decade. In the 2010s, employment was growing by around 1% per year on average. So that's obviously a very big change. Another key factor that the fiscal stimulus won't really address are the big headwinds to German industry. If I pick out, for example, the auto sector, the big problem there is that just the demand for the internal combustion engine cars that Germany was so good at producing is going to be much lower in the next decade, both because growth in Europe is going to be weak, the European population is going to fall, but obviously, for example, also because in China, the Chinese firms now produce EVs themselves and will even export them into Europe rather than buying the German cars. So that's also going to continue to weigh significantly on the German economy.
But aren't there positive spillovers from all of this spending on defense or on infrastructure?
Yes, there obviously are. And if I think about some sectors that will in particular benefit from this higher spending, we're thinking about the defense sector, which we've already seen, even taking over some idle car part factories in Germany, so expanding their production capacity. But the defense sector is very small. It's less than 0.5% of GDP, which compares to around 6% of GDP for the car sector, which is not going to benefit much from the fiscal stimulus. And construction obviously will also benefit from increased infrastructure spending. That's a bigger sector. It accounts for around 5% of German GDP, so potentially a bigger boost there. There's a lot of other sectors that in Germany that will continue to struggle. For example, machinery equipment, a very big sector, will struggle from reduced demand from Europe and from China again. And obviously, a lot of that fiscal stimulus money will also go partly into imports from other countries. So overall, I think the headwinds to the rest of industry are still significant enough that the fiscal stimulus will not be enough to fully counter them, even though some specific sectors will clearly benefit.
Okay, so taking a step back, very capital economics phrase, isn't it? But when we talk about Europe's potential as this sort of geo-economic counterweight or third pillar alongside the US and China, this third superpower that Emmanuel Macron has talked about in the past, it seems to me it really comes down to whether Germany can overcome these economic challenges that you've talked about. And you're basically saying there's not enough here to suggest that's going to happen. Yeah, bit more spending will lift GDP growth to, say, around 1%, boost some sectors a lot, but nowhere near enough to really change the story, right?
Yeah, I think you're right. Germany is obviously the largest economy in the EU, and for Europe really to emerge as a third superpower, one would expect it to be necessary for Germany to return to much stronger rates of growth. Perhaps other things to add to why we're skeptical of a third bloc around Europe is, for example, Germany also will lose a position of being the leader in something, right? If you think about the 2010s, for example, Germany was known to make the best cars. And in the next decade, it's hard to see still what areas of leadership, for example, within economic sectors Germany could have. Another problem also might be that perhaps what you would need would be for Germany also to assume more of a leadership within Europe in terms of proposing, an actually positive agenda for the EU rather than perhaps just leading the way in deciding how to manage the latest crisis, which was always a bit the role that Germany assumed, deciding what way to go and to manage the COVID crisis or the financial crisis. Now it might be a bit like this for defense, but I'm not sure that the new German government, for example, wants to really have some form of positive agenda in terms of really pushing for more European integration in the capital markets union, improving the single markets. That doesn't seem to be, for now, a big policy priority.
That was Franziska Palmas on the future of Europe. I will add a link to the dedicated page housing all of the analysis to the podcast notes, and do look out for those drop-ins in the coming week. Finally this week, as Neil and I discussed, there has been a stunning shift in sentiment around this trade war that could be most clearly seen in financial markets. The S&P 500 has recouped all of its Liberation Day losses and is now up for the year. As of the time of this recording, which is just before the Friday Open, it's less than 4% off its all-time high. So was it all just a feverish dream and we can go back to being unmitigated bulls? I spoke to Chief Markets Economist John Higgins for an update, and I started by asking him what he made of the bounce back of the past few days.
We've obviously seen a big rebound, haven't we, David, since the low point just over a month or so ago in the wake of Liberation Day. Clearly, that's connected, if you like, to a more positive tone coming out of Washington with regards to deals that may be done and the pausing of reciprocal tariffs, initially, obviously, on countries excluding China, but now more recently on China itself. I think if you look at the markets, you'll find that in most cases, things have gone back pretty much to where we were pre-Liberation Day, even possibly a little bit higher. There are a few residual signs of stress in the markets, but they're quite hard to spot. And I think some of those aren't actually necessarily directly connected in any case to trade and tariff policy. They're more reflecting lingering concerns perhaps about fiscal policy. For example, if you look at the steepness that we've seen of the US yield curve and slight pickup there in sovereign credit default swap premium on the US, I think those are more indicative really of as I said, that concern about the bill currently making its way through Congress and the debt ceiling standoff that will become bigger issues as we move forward over the next couple of months rather than anything else. And of course, some of the weakness that we'd seen in the stock market was also connected to this idea of an emerging challenge to the US's dominance of AI from China. And again, that's something I think that is still out there. Just because the concerns about trade and tariff policy have subsided doesn't mean that that challenge, if you like, is going to go away anytime soon. And I think that sort of helps to explain why we haven't seen perhaps an even stronger rebound in the market.
Okay, but it has been strong nonetheless. And I was just talking to our colleague Neil. The point he makes is, yes, the global economy is in a much better place, but there are several flashpoints, if you like, lying ahead of us. So I guess my question is the market setting itself up for a fall, given that we are still looking at these enormous uncertainties with regard to how this trade narrative plays out, and indeed the actors behind it? I mean, you've got these personalities who can be quite mercurial in their approach to policy. So the risks haven't gone away, have they?
The risks haven't gone away, but I'm not convinced actually that the market is setting itself up for a fall. And of course, things are pretty fast moving, and we did actually downgrade our forecast for the S&P 500 substantially just after the Liberation Day announcement from what was a bullish forecast for the end of this year, coming on the back of a very bullish forecast that we had for the previous one that actually materialized. And we downgraded that forecast for the end of this year for the S&P, which was actually 7,000, for a couple of reasons. One was the sense that the Liberation Day announcements themselves were going to create an economic backdrop, if you like, that was really not conducive to a rally more generally in equities, even if the economy still managed to skirt a recession. And the second one was that just around the same sort of time as Trump returned to the White House, we did have this news around DeepSeek, and which sort of crystallized the idea of a threat, if you like, to the US's dominance of AI from China. And we felt the combination of those two things was sufficient to hold the market back. So we lowered our forecast all the way down to 5,500 for the S&P 500. So for the benefit of hindsight, it looks like it may have been premature for us to have downgraded the forecast to that sort of number, simply because obviously there was this rapid rollback of tariffs that came shortly afterwards that completely changed the mood music in markets. So I think things have changed substantially really over the last month or so. We're just in the process actually of re-reviewing, as it were, the forecast. And I think the chances are we may well project an even stronger market than we have right now, by the end of the year, notwithstanding the fact that we've seen this big bounce in recent weeks. And I think the reason for that is just, the mood music, as I said, is more positive. I think it is now conducive to a further rally in risky assets. The challenge to the US's dominance from China hasn't gone away, and that's a reason for us perhaps not to be as bold as we once were in terms of our view for the S&P 500. So I doubt we'll be revising the forecast up for this year all the way back up to 7,000. But you talked about some of the threats that's still lingering in the background to the market, whether it's setting itself up for a fall given this big rise that we've seen. I'm not sure about that. I find it hard to imagine a world in which we're going to go back to the reimposition of these tariffs. I think it's more likely that they'll be rolled over if we don't get deals cut within the 90-day windows. It's also hard to imagine the US administration wanting to potentially upend the bond market by reimposing tariffs in sort of July and August when these 90-day windows are up, because that could coincide with the debt ceiling standoff coming to a head. So you'd have two potential threats there to the Treasury market. And let's not forget it was the rout in the Treasury market that prompted a bit of a rollback on tariffs in the first place. I don't think that we're necessarily going to go back to those stresses and strains in markets that we saw after the Liberation Day announcement, just because this truce, if you like, in the trade war between the US and China in particular doesn't end up being a lasting ceasefire or the last word on the trade war.
I mean, a lot of what we've been talking about is about valuations and valuations adjusting, but for all of the uncertainties or potential for things to go wrong, the fact is that now, and I think our assumption is for the future, US tariff rates will still remain at multi-decade highs. We've had companies this earnings season talking about their need to raise prices, Walmart most notably. So with all that being said, what does the earnings side of the price earnings ratio look like here?
Well, for all the talk about tariffs are going to drive the economy into the ground and significantly raise prices, the reality is that earnings expectations really haven't faltered much of at all. Even when we were in the midst of a substantial decline in the stock market, the channel through which that was occurring was a decline, if you like, in the price that investors were willing to pay for earnings rather than in the earnings themselves. Now, admittedly, analysts can take their time to actually revise down their expectations for earnings, but we've had a bit of time now to adjust, and there really hasn't been this big downgrade of earnings expectations that you typically do see when the economy is about to head into the soup. I think what's going on the earnings front really, to me, is not really consistent with the idea that the market is worried about a recession at this point. It might have been 4 or 5 weeks ago, but I don't see it in analysts' expectations for earnings. And of course, because the market has had this setback through the valuation channel rather than through the earnings channel, that has actually left the valuations of some sectors of the market looking, I wouldn't say necessarily attractive, but certainly a lot more reasonable than they were, which I think, again, creates some scope, if animal spirits did return here, for the market to continue to climb.
That was John Higgins on the mood change in markets and the potential for more upside. He's done a stream of notes following that US-China deal, outlining what this means for our core markets views. They're published as part of a product called Capital Daily. These are short, forward-looking commentaries out each trading day to highlight key developments across global markets, look ahead to the big events, and point you to important pieces from the rest of the macro and markets teams. I'll add some to the podcast notes to give you a flavour, and our markets forecast dashboard to boot. But that's enough from me for this week. We will be back next week with more from the world of macro and markets. Until then, goodbye.